Hello friends, I welcome you once again in my class. So today we are going to start module D, that is the balance sheet management, and starting with the chapter 22, there is the components of asset liability in banks and balance sheets. So today we'll be discussing about the asset liability management. Okay, so asset liability management is done at two levels. One at the macro level, other the micro level. And you can see that at the macro level, asset liability management involves the formulation of critical business policies, efficient allocation of capital, and designing a product with appropriate price strategies. So this function is done either at HO level or your treasury. Okay. And at micro level also, asset liability management aims at achieving the profitability through price matching while ensuring liquidity by means of maturity matching. So this is also done by HO level. That means main function of ALM in bank lies with the HO or treasury. And what is ALM therefore? So ALM is nothing but management of net interest margin. Okay. So net interest margin means we have to manage the net interest margin. What is net interest? So net interest income is nothing but whatever interest we gain and whatever interest we pay. Okay. So is to what is the net interest margin to ensure that its level and riskness are compatible with the risk return objective of the bank. So whatever net interest we are running, that should match with the risk level of the bank. If more risk is there, so naturally we should aim to get more net interest margin. Okay. The strategy of activity managing the composition of mix of assets and liability portfolio is called balance sheet restructuring. That means we should always try to balance the mix of asset and liability. Therefore, there should not be volatility on short-term profit. If volatility is there, that means our net interest income will fluctuate. There should not be stability. So we should always try to be stable. That means same for a long duration we should try to get the same interest. Okay. And what is net interest income? So net interest income is nothing but interest income minus interest expenses. That means whatever interest we are getting out of the assets and whatever the interest we are paying in the expense in the liability, that is called net interest income. So if you minimize the net interest income, that means we are more stable. Okay. Then what is net interest margin? So that means whatever net interest income is there, if we divide by average total asset. Okay. We have to divide by average total asset. Then we'll get the net interest margin. Okay. Then net interest income is nothing but whatever interest we get out of the asset and whatever the interest we pay out of the liability, that is called net interest income. If we divide this by average total asset, we get the net interest margin. And net interest margin can also be viewed as spread. Sometimes we talk about what is your spread. That means net interest margin can be viewed as spread on earning asset. So we will say if your net interest margin more, that your spread is more. But nowadays, due to competition, the making a big spread is not possible. Okay, the higher the spread, more will be the net interest margin. Okay, the the ratio of shareholder fund to the total asset. The ratio of shareholder funds to the total assets, that is also called economic equity ratio, measures the shift in ratio of own fund to the total fund. This fact assesses the sustenance capacity of the bank. That means if ratio of shareholder with respect to total asset is more, that means the own fund means we are shifting from our own fund towards others. So we always try to sustain that. Shareholders fund to total asset should be minimized. Okay. Next, price matching basically aim to maintain the spread by ensuring that deployment liability will be at the rate higher than the cost. That means whatever the liability you are taking, and then you deploy the liability, that become the assets. Okay, so in other words, you can say the interest charge on the asset always should be more than the interest paid in the liability. Okay, and liquidity is ensured by grouping the asset liability based on their maturity profile. So this is the main problem with the banks, no, because there's always liquidity mismatch. So the higher level they always try to that there should not be liquidity mismatch. Okay, gap is then assessed to identify future financing requirement. Okay, so liquidity means whatever assets you are getting and whatever liability you are having, so their time period should match, and maturity profile means their time period should match, otherwise liquidity mismatch will be there. Okay, next moving ahead, what is the profit? So profit means whatever you are gaining and whatever you are paying. Okay, the C, interest income, non-interest revenue you are getting, interest income, non-interest revenue we are getting. Okay, not whatever you are paying, that means interest expenses we are paying, provision of loan or losses we are incurring loss we are paying, non-interest expenses we are paying, and taxes we are paying. So that means profit is nothing but interest income and non-interest income, then whatever expenditure they subtract will get the profit. And then moving ahead, we'll start with the unit 23, systemic risk. So systemic risk is nothing but risk that default by one financial institution will create a ripple effect that lead to default by other financial institution and threaten the stability of the financial system. Okay, that means if one financial system is defaulting, then it will lead to the default of other financial system because they are interdependent, and that will have the ripple effect. So with this, if bank is failing, that it will lead to failure of other bank also. Okay, because banks are interdependent on each other. In calculating the Cooke ratio, yes, they know this Cooke ratio is nothing but CRAR. Keep in mind. Okay, so Cooke ratio both on balance sheet and off balance sheet items are considered. Only thing is that you have to keep in mind both on balance sheet and off balance sheet items are considered. They are used to calculate bank's total risk weighted asset. It is a measure of bank's total credit exposure. So what is the formula? CRAR, capital divided by risk weighted assets. Okay. Now we'll see what is tier 1 capital, tier 2 capital. So tier 1 capital basically consists of mainly of share capital, disclosed reserve, and bank's highest quality capital because it is fully available to cover the losses. Okay. Tier 2 capital on the other hand consists of certain reserve and certain type of subordinate debts. The loss absorption capacity of tier 2 capital is lower than that of the tier 1. This very important point is loss absorption capacity of tier 2 capital is much more lower than the tier 1 capital. Then we'll see what is the capital adequacy, that is the unit 24, or you can say chapter 24, Basel second overview. This is very important. Okay, Basel committee provided the framework for capital adequacy in 1988, which is known as Basel I Accord. Okay, Basel I Accord provided global standard for minimum capital requirement for banks. After that, Basel II came. First Basel I came in 1988, and after that Basel II came. Okay. Now, revised framework consists of three mutually reinforcing pillars. So, in Basel II, three mutually reinforcing pillars. These are number one, minimum capital requirement and supervisory review of capital adequacy. I can say supervisory review process, minimum capital requirement, supervisory review process, or you can say supervisory review of capital adequacy, and market discipline. Not only that, this framework offers three distinct options for computing capital requirement for credit risk and three other options for computing capital requirement for operation risk. Okay, that means how computing capital requirement. Distinct options means how to calculate. We have already studied now three options. So these are they give the three options to calculate the credit risk and operation risk. And what are these options? Number one, for the credit risk, we have to remember these options because this can be asked sometimes. No, standardized approach. Number two is the internal rating based foundation approach, IRB. First standard, second is IRB foundation, and third is IRB advanced. So you can remember like this: SII, SII, standardized approach, internal rating based foundation. Internal stand for II, same internal rate based foundation and internal rating based advanced. So foundation and advanced. First come foundation, then come advanced. Now that means SSI. The options available for computing the market. Available for the market list are now see. There will be SS. It must be I. Standardized approach based on maturity and based on duration and advanced approach. Internal model. There is internal model. That means in the you can see of credit risk, it was SSI, SSI, and market CMO. We are following the pattern CMO. We are going to like CMO. No, first credit, then market, then operation. Then for the market, SSI. First SII, then SSI. So what is SSI? Standardized approach. Both are same as standardized approach based on maturity and duration. Means one standardized approach is maturity, another is standard approach duration. Okay, and internal model approach. Internal model approach is advanced. So that means SSI. Now going for the operation. So operation is BSA. You can remember like BSA. Short form only, just I'm keep in mind. Okay. The option available for the computing capital for operation risk are basic indicator approach, standardized approach, and advanced measurement approach. So BSA you can see. So in this way you can see, you can remember. The revised capital adequacy norm shall be applicable uniformly in all commercial banks except local banks, local area bank, and regional. So that means this revised capital adequacy, CRAR, maintaining the CAR, is not applicable to RRBs and local banks, and applicable to all other banks. Okay, all the commercial banks. A consolidated bank is defined as a group of entities where a licensed bank is the controlling authority. So this is only different definitions. Okay, all commercial banks in India shall adopt. Yes, now which method we were going to adopt? So all commercial banks in India are going to adopt standardized approach. Means first one. Okay, for credit and basic indicator approach for operation. That means first one. Okay, for credit we are using a standardized, means S was the first. For operation we are using basic approach. And for market, we'll see the market. Okay, we'll come back once again. And that means for all commercial bank India shall adopt standardized approach for credit risk and basic indicator approach for the operation risk. Bank shall continue to apply standard approach, duration approach for calculating the market risk. So market we are having the standardized approach. Now see where that means standard and basic. Standard and basic. That means first. In all we are having the first. Okay. SII, SSI, and BSA. So I told you. So first you have taken. That means I'll just repeat once again here so that you can remember. For credit risk, standardized approach. Okay. For an operation risk, basic indicator approach. Okay. and for the market risk again instant. But here is the duration. Okay, second one. So here's the duration, because duration was the second in the list. Okay, you can see once again here. I'll just show you duration. First was the maturity ladder, and second was the duration. I will mark here. Here, so first was the maturity, second was the duration. So that you can remember. Okay, the term capital would include tier one and tier one. Tier one is also called core capital. This is very very important. And tier two is called supplemental capital. Okay, tier 1, tier 2, and tier 3. Tier 3, India, we are not following the tier 3. We are not having anything. So, just for knowledge sake, tier 3 is there, but we are not following. So, that means tier 1 is called core capital, tier 2 is called supplemental capital. Okay, core capital consists of, once again, I repeat here, paid up capital, free reserve, and unallocated surpluses less specified deductions. Whatever deductions are there, will subtract. Okay, next, supplementary capital means tier 2 comprises of subordinate debts of more than 5 years maturity, loan losses reserve, revaluation reserve. Revaluation reserve will take only the how much take only if we take only 45%. Okay, that means 55% will subtract, 45% will take. And investment fluctuation reserve and limited life preference shares. So these are the part of the supplementary capital. Let me tier 2. So tier 2 capital is restricted to 100% of tier 1 capital as before. That means tier 2 capital is restricted to 100% of tier 1 capital as before, and long-term subordinate debt may not exceed 50%. This point is very, very important for numerical point of view. Okay. And tier 3 capital, if it is there, no, it's not there. Tier 3 capital will be limited to 250% of the bank tier 1 capital that is required to support the market risk. Okay. This means that this point is not important. Okay, just we'll see. This means that a minimum of 28.5 market risk needed to be supported by tier 1 capital. Any capital requirement arising in respect of credit and counterparty risk need to be met by the tier 1 and tier 2 capital only. Okay. Now, next, moving ahead, capital adequacy ratio equal to regulatory capital divided by total risk weighted assets. So, same CR formula we have already seen in the previous videos. So, same formula is given here. And now is a formula we have already seen, CRAR. Okay, next we'll see the next chapter, supervisory review. So number one, the pillar one is the minimum capital requirement. This prescribe a risk sensitive calculation of capital requirement that for the first time explicitly include operational risk in addition to market and credit risk. Okay, so minimum capital requirement, we have already talked about the CRAR. Okay, and minimum capital requirement as per Basel it is 8%. In India we are following the 9%. Okay, and pillar 2, supervisory review process. That means it envisages the establishment of suitable risk system in bank and their review by the supervisory authority. Like in our banking system, the zonal office and ROs they are our supervisors. They keep on coming for inspection. So this is the part of Basel II norms only. That means supervisors are coming and inspecting us. Okay. Now market discipline. In this that banks are to disclose their to the public. So which seeks to achieve the increased transparency through expanded disclosure requirement for the bank. That means banks are, you might have seen a bank, they disclose their audit in the public either through newspaper or in the website. So that should be a proper. They should not hide, so that the customer, those who are linked with the bank, they should take their proper decision. So we'll more talk about the market discipline. So market discipline is a complement, is to complement the minimum capital requirement, pillar 1, supervisory review process, pillar 2, and pillar 3 provide disclosure requirement for the bank using Basel II framework. Okay, so information would be regarded as material. That means bank are to disclose their information like material if it is omission or misstatement could change the influence of the assessment or decision of the user relying on the information for the purpose of making economic decision. That means banks should give the proper information to the public so that they can take their correct economic decision. Okay. Now next, asset classification and provisioning norms. Yeah, banks should classify an account as NPA only if interest charged during any quarter is not serviced fully within 90 days from the end of the quarter. So that means an account will be called as NPA if so an account will be called as NPA uh, if during any quarter is not serviced fully within 90 days. That means no interest and no principal has been paid back by the customer. An account should be treated as out of order if it is outstanding balance remain continuously in excess of sanctioned limit drawing power. Okay, that means account will be called. It's talking about the current account or any other account. So treat as out of order if outstanding balance remain continuously in excess of sanction limit. Okay, or drawing power. And in case where the outstanding balance in the principal operating account is less than the sanction limit drawing power, but there are no credit continuously for 90 days as on the date of balance sheet, or credit are not enough to cover the interest debited during the same period, then these accounts will be treated as out of order. That means even though the balance is less than the sanction limit, but you might have seen due to interest that is rising the amount, so interest is becoming more, and it is debited from the account, but they are not paying the interest. Okay, that is not crediting the interest. That account will also called as a out of order account. So any amount due to the bank under any credit facility is called overdue. And interest on advances against term deposit like NSC, KVP, IVPs are there, life policies are there, life insurance policies may be taken to income account on the due date, that means accrual basis. Okay, because these are government policies. So interest on advances against, okay, interest on advances against this term deposit you can take on the accrual basis. Okay, a substandard asset would be one which is remain NPA for period less than or equal to 12 months. That means after NPA. So after SMA, you can see SMA 0, SMA 1, SMA 2. After 90 days, it will be called as a substandard. Okay, up to 12 months. And after 12 months, doubtful. Okay, a doubtful 1 is 1 year. And again, doubtful 2, 2 years. And then doubtful 3, again 1 year. And after that, loss. So these are duration. Okay, 1 year, 2 year, and again 1 year, and there will be loss. So if areas of interest and principal are paid by the borrower in the case of loan account classified as NPA, the account should no longer be treated as non-performing asset. That means during the period of NPA, the account is NPA, but sometimes what happens though, customer they pay the whatever the areas outstanding is there, so that will become performing assets. Okay, so I'll repeat once again here. Advances against term deposit, NSC, KVP, IVP need not be treated as NPA. Advances against, this is very, very important. Advances against term deposit, NSC, KVP, IVP need not be treated as NPA. The advances against gold, ornament, government securities, and other securities are not covered by this exemption. Okay, that means if you are giving advances against NSC, KVP, IVP, that will not be treated as NPA, whereas advances against gold ornament, government securities, and other securities may be treated as NPA as per the norm. Okay. Now moving ahead, liquidity management. So in banks, the liquidity management is the process of generating fund to meet the contractual or Relationship obligation at reasonable price at the all times. So we always try to maintain the liquidity. Okay. And good management information system, IMS, है ना? Good MIS, central liquidity control, analysis of net banking requirement and other alternative scenarios, diversification of fund source and contingency planning are crucial element of strong liquidity management. This is done at HO level, HO level and treasury level. Okay, at the bank of any size of scope and operation. Now, residual maturity profile. Residual maturity profile of asset liability will be such that mismatch level of time bucket 1 to 14, 15 to 80 days remain around 80%. That means here are the time duration of mismatch. That means 1 to 14 days, 11 to 80 days always should be 88% of the cash outflow in each time bucket. And for liquidity mismatch, we are following one approach is there, that is flow approach. Flow approach is the basic approach being followed by Indian banks. It is called CAIIB method. Okay, measuring and managing liquidity. So for the managing liquidity, we are following the flow approach, or you can say basic approach. Sometimes we call it a CAIIB method also. Okay. Stock approach is based on the level of asset and liability as well as off balance sheet exposure on a particular date. And ratio of core capital. Now we'll see the ratios. Some of the ratios are here. So you can see ratios of core capital to total deposit. Ratio of core deposit means more deposit total. Core deposit total assets. More the ratio, better it is. So more deposit, we are at the better place. Net loan to total deposit ratio. That means net loan to total. Net loan to it is reflect the ratio of loan to the public deposit or core deposit. Loan is treated to be less liquid asset and therefore lower the ratio, better we are. So this we can calculate to see our position. This is for the liquidity purpose. Okay. Ratio of time deposit, total deposit. Time deposit provide stable level of liquidity and negligible volatility. Therefore, higher the ratio, better it is. Ratio of volatile liability to total asset. Volatile liability at the numerator. Higher portion of volatile asset will pose higher problem of the liquidity. Okay, so this value should be less. Therefore, lower the ratio, better it is. Ratio of short-term liability to liquid assets. Short-term liabilities are required to be redeemed at the earliest. It is expected to be lower in the interest of liquidity. Ratio of liquid asset to total asset. So higher level of liquidity asset in the total asset will ensure better liquidity. Therefore, higher the ratio, better it is. Liquid asset may include bank balance, money at call, short notice, interbank placement, due within 1 month, securities held for trading and available for sale having ready market. Now we'll see next what is the ratio? Ratio of short-term liabilities to total asset. A lower ratio is desirable because short-term liabilities to total asset. So because short-term liability they pose the problem for liquidity. So lower the ratio, desirable. And short-term liabilities may include, because we have taken the short-term here, short-term liability may include balance in current account, volatile portion of saving account, because some of the customer they can withdraw more frequently. So volatile portion in saving account. Leaving behind core portion of saving which is constantly maintained, maturing deposit within a short period of a month. So your FD also may be maturing within 1 month, called a short-term liabilities. Okay, next ratio of prime asset to total asset. So prime asset divided by total asset, more or higher ratio is better because asset is always better for the bank. So moving ahead, next prime asset may include cash balance with the bank, balances with the bank including central bank, that means RBI, which can be withdrawn at any time without any notice. So prime asset is always better for the bank. Okay, next, ratio of market liability to total asset. Lower the ratio, better it is. Because market liabilities may include money market borrowing, interbank liabilities, repayable within short. So, because market liabilities are very volatile. Now, maturity ladder should be used to compare banks' future cash inflow to its future cash outflow over a series of specific time. So we have discussed now standard maturity and part of operation risk. Okay. So maturity ladder should be used to compare banks' future cash inflow to future cash outflow over a series of specified time period. The need to replace net outflow due to the unanticipated withdrawal of deposit is known as funding risk. This is replace net outflow funding risk. Okay. Need to compensate for non-receipt of expected inflow of fund is classified time risk. Very, very important. I'll repeat once again. What is funding risk? Need to replace net outflow. Outflow means going, interest paying. Due to unanticipated withdrawal. Some of the customers, they will come in the one day, okay, I want to prematurely withdraw 5 lakh rupees of things. So, it's known as funding risk. Need to compensate for non-receipt of expected inflow. Need to compensate for the non-receipt of expected flow. We were expecting that we'll be getting this interest, but we are not getting. Okay, this is called the time risk. This is opposite to funding risk. Call risk arises due to crystallization of contingent liability. Yes, contingent liability. You have given one guarantee, but now it is being crystallized. That will come call risk. Okay. Maturity letter enables the bank to estimate the difference between cash inflow and cash outflow predetermined period. Okay, so I will discuss here what is maturity letter. So it enables the bank to estimate the difference between the cash inflow and cash outflow in predetermined period. Okay, liquidity management methodology of evaluating whether a bank has sufficient liquid fund based on the behavior of cash flow under the different situation. What if scenario is known as alternative scenarios. Okay. Next, the capacity of bank to withstand a net funding requirement in a bank specific and general market liquidity crisis is denoted as contingency planning. Okay, so bank has to plan contingency also. That means they have to contingent planning. Okay, so capability of bank to withstand net banking requirement in a bank specific general market liquidity crisis. That means in during the crisis also banks should be able to pay the customers. Customers should not come and wait for hours for their money. Okay. Now moving ahead, yeah, we'll talk about the unit 9, interest rate risk management. Okay. So interest rate risk is the exposure of bank's financial condition to the adverse movement in the interest rate. So what is gap? Gap is the difference between the amount of asset and liability on which the interest rate are reset during the given period. So called the gap. That means different rates are there for the asset and liability. So interest rate refers to volatility in net interest income or variation in net interest margin. So net interest margin nothing but net interest income divided by total asset. Okay. Degree of basis risk is fairly high in respect of bank that create composite asset out of composite liability. And risk that the interest rate of different asset and liability may change in different magnitude is called basis risk. Basis rate, we have seen the change in the interest. Risk that interest rate of different asset liability may change in different magnitudes. Okay, like asset interest is changing from 6 to 7, and for liability changing from 5 to 5.5. So degree is different. It is changing for 1%, it is changing 0.5%. Okay, so this is called basis risk. Okay, when asset and liability fall due to repricing in different periods, they can create mismatch. Okay, and when asset liability fall due to repricing of different periods. Okay, such a mismatch or gap may lead to gain or loss depending upon the how interest rate in the market tend to move, because this rate of interest is very dangerous. Degree of basis risk is fairly high in respect of bank that create composite. We have already seen discussed here. So once again reiterate here. Degree of basis risk is fairly high in respect of bank that create composite asset or out of composite liability. Out of composite liability. Okay. When the variation in market interest rate causes the NI, net interest income, to expand, the bank have experienced the favorable basis shift. And if the interest rate movement causes the net interest income to contract, expand and contract, the basis has moved against the bank. So that means uh, so I'll reiterate once again here. That means when the variation in market interest rate causes the net interest income is expanding, that means good for the bank. Okay, when net interest income is contracting, means reducing, it is bad for the bank. Okay, a yield curve is a line on graph plotting the yield of all maturities on a particular instrument. That means we plot some yield graph now. So there's a yield curve is a line. So just introduction I have told you. Okay. Next, price risk occurs when assets are sold before their maturity dates. So when you sell one asset before the maturity date is there, that becomes the price risk. Okay. The price risk is closely associated with the trading book because mark to market, which is created for making profit out of short-term movement in the interest rate. So trading book, whatever the items are kept in trading book, they are for the profit only. Uncertainty with regard to interest rate at which the future cash flow can be reinvested is called the reinvestment risk. Okay, that means future cash flow. Okay, you must be getting some interest out of your asset. That if you are reinvesting that, and the interest rate is changing, that is called reinvestment risk. When the interest rate goes up, bond price decreases. We already seen in the past. When the interest rate decline, the bond price increases, resulting in a capital gain. Interest rate decline, capital gain. Keep in mind. So because bond price increases and the realized compound yield decreases because the lower coupon reinvestment income. Okay, so you can correlate interest rate decline, yield decline. Duration is a measure of percentage change in the economic value of the position that will occur given a small change in the level of interest rate. Okay, higher duration implies that given change in level of interest rate will have larger impact on the economic value. Higher duration means have larger impact, and lower duration means lower impact. Rate sensitivity gap is very important. Okay, interest rate sensitivity RSA minus RSL. What is RSA? Rate sensitivity assets minus rate sensitivity liability. Positive gap or asset sensitive gap, RSA minus RSL means asset minus liability. Rate sensitivity asset minus rate sensitive liability means it is positive. Okay, negative gap. So liability will come first and you will get the negative value. RSA minus RSL is there, but you will get the negative value. Okay, so we have finished our module D in one go. So thank you very much for watching. And one advice to all of you, please do practice numericals given in IBA book. That means in Macmillan publication, you must practice some numericals. Okay, numericals given as examples are very important for examination point of view. And BFA is little difficult as compared to ABM. So keep studying, stay healthy, all the best. And our third paper will be starting after the exam. That means when exams are over, will be left with the 11 days. We'll cover that subject also. Thank you very much. Have a nice day.